Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I am very excited to launch another earnings season and talk about not only how do I go about trading earnings season, but more importantly, how do I actually research ideas? This is probably the number one question that I get around earnings. Some of you have followed me on CNBC and you see the trades that we do during earnings season. The question that I always get is, how do I know whether a stock is going to beat or miss on earnings? And the reality is I don't know, but I do have a set of rules and things that I look at in order to determine whether I think a stock is going to beat or miss. And we're going to talk about those things today. And more importantly, also, how do I take advantage using options around earnings season? So we're going to go through all of that here today. But before we do, what we are going to discuss here is purely for education and demonstration purposes. The examples that I'll use here today is not a solicitation or recommendation to buy or sell any of the specific securities that I'm discussing here today. So we'll first start off by talking a little bit about what my expectations are for this upcoming earnings season. And largely, this is going to borrow from the overall trends that we see from earnings season from quarter to quarter. The slowdown that we're starting to see in terms of earnings growth and revenue growth, as well as how stocks are performing when they beat or miss. So those are important metrics to understand to set yourself up for the upcoming earnings season. Then we'll talk a little bit about the option strategies, but more importantly, how options pricing around earnings are how options prices are affected by earnings. Very important to understand if you're going to utilize options for trading earnings. Then we'll talk a little bit about this earnings research. Like I said, the number one question that I get is, how do I research stocks that I think are going to beat or miss? How do I find these opportunities? I'm going to walk you through step by step what tools I use, how I look at that data to make my analysis, and then go through a real example for you before we open this up for Q&A. Now, before I get started, I just want to reiterate the main point that I want to have everyone who's viewing this today a clear understanding as to how can I research and trade earnings season with limited risk using options. So before I jump into it, could everyone please bring up your chat window, which is at the bottom of your screen? And I'm curious, how many of you have traded earnings using options before? Please type yes if you have, and please type no if you've never traded earnings using options before. Okay, a large number of yeses, but actually a surprising number of nos. So a lot of people saying trying to avoid. Okay, interesting. So hopefully in today's session, I'll show you how you can potentially utilize options to protect yourself, because I think a lot of investors that are watching here today, many traders are afraid to trade earnings because you see it as this volatility event that could bring in some substantial losses. So what I want to show you is what option strategies I use and how do I think about which option strategies are suited for me, and then how do I figure out which stocks to trade these strategies on. So let's go ahead and get started. We'll start off by just talking a little bit about how did earnings season last quarter play out and what are expectations for this quarter. So last quarter was a fairly strong quarter, 39% year over year increase in earnings per share versus the 28% that analysts were expecting. So we beat the analyst expectations by about 11%. That's a pretty sizable beat in terms of overall markets. And especially that was a bigger beat on earnings versus revenue. So revenue consensus was 14% and came in at about 16% year over year growth. Now, the one thing I will say is that year over year, Q3 is comparing to Q3 of 2020. Q3 of 2020 was obviously a challenging year, so 39% increase year over year sounds like a large increase, but it's actually comparing to a lower base. 16% sales, also a large increase, but compared to a lower base. But the one thing that I will say is that 10 out of 11 sectors beat the consensus on earnings. So this is really a fairly strong quarter that we saw last quarter. But the one thing that wasn't particularly strong was that only 58% of S&P 500 beat on both top and bottom line. That means the number of stocks that beat revenue and earnings expectations came in at about 58%. That's relatively low, especially compared to the previous quarter in Q2, where we saw about 79%, almost 80% of all companies beat top and bottom line. This has declined to 58%. So there's a clear deceleration and clear slowdown in terms of companies being able to beat what analysts are expecting. But the most important metric that I think is that we have to pay attention to, that really inform most of my decisions around earnings season, is not necessarily how whether or not a company beats or misses, but more importantly, how does a stock react after a beat or a miss? And this is the one metric that I talk about every single earnings season. So if you've watched me over the past few quarters on these sessions, and I always do an earnings preview before each earnings season, we talk about the stats from the previous quarter. On last quarter in Q3, when a stock beat their earnings expectations, they only gained 0.3%. That means when a stock beat its earnings, it barely nudged higher. But on the flip side, stocks that missed on earnings moved on average of 1.64% to the downside. So what this means is that the reaction of the market when a stock misses is much, much larger than if the stock beats. And this is going to help you inform your decisions as to, should I focus more of my attention looking for stocks that I think are going to beat, or do I focus more of my attentions on stocks that are likely going to miss? Now, this is something that will change quarter over quarter. And what we saw last quarter doesn't mean that we're going to see the same thing this quarter. But these trends, generally speaking, take a bit of time to shift. You usually don't see huge shifts in how markets react. And we've seen this type of reaction for at least 2 quarters now. We saw it during Q2, we saw it during Q3. And my expectations for Q4 is that it's likely going to still be the same. So as of right now, consensus expectations for Q4 is that we're going to see a 20% increase year over year on earnings, an 11% increase in revenue versus Q4 of the previous quarter. We were expecting a 28% growth. Now we're at 20. The previous one we were expecting 14. Now we're expecting 11. So that is certainly a slowdown in terms of expectations, but we are comparing to Q4 of 2020, which was better than Q3 of 2020. So these numbers are still strong in terms of our expectations for earnings. But I think the biggest concern that we see here in Q4 are really the rising labor costs. This is something that continues to pressure, especially when we talk about whether inflation is transitory or permanent. We are seeing more and more data points that show us that the inflationary environment that we're in is less transitory than we may have thought earlier in the year. This has significant cost pressures on labor as well as raw materials. And this is largely going to drive margin compression. I think that's going to be a major theme here in this particular earnings season, especially when we talk about consumer discretionary and industrial sectors, 2 sectors that have a large percentage of their expense in the form of labor costs. So, and then we also want to talk a little bit about the Omicron impact on services. As of right now, analysts haven't really revised many of their expectations on airlines and some of these, restaurants, these services type businesses that are more likely to be affected by the recent wave of Omicron. But when we look at the underlying data behind it, services PMI, those are looking pretty weak. And I think that you might see some further downside in some of these more sensitive sectors to the reopening trade, as well as sectors that are sensitive to labor costs. So those are some of the expectations that we currently see here for the upcoming earnings season. And when we look for opportunities, we typically look at which sectors have analysts revised their earnings expectations higher as we approach earnings season, and which sectors have analysts revised the expectations lower, because that gives us some clues as to which sectors may have a better chance of beating and which sectors may have a better chance of missing. Financials and energy, two of the strongest sectors right now in terms of upward revisions, including real estate, which is a bit of a silent rotation that we're starting to see here in real estate. Those are the three sectors that are currently scanning the best for earnings. And then we have utilities and communications that are currently seeing the largest downward revisions. And I will say, I do think consumer discretionary is worth mentioning. Even though we haven't seen analyst expectations come down in consumer discretionary, I can't help but think that this is going to be one of the sectors where you are going to see some names see some significant downside. We saw Lululemon report a couple of weeks ago, saw some significant downside there. I think you're going to see more casualties in this particular space. So those are the opportunities that I'm currently looking at. Does that make sense? Please type 1 into the chat window if that makes sense, or if you're just following along so far. Perfect. Okay, so now that we have discussed the earnings preview here, let's talk a little bit about options and options strategies, because largely when you're thinking about option strategies around earnings, you have two choices, and one choice is not better than the other. It's just a matter of understanding what are the pros and cons of each one in order to understand which one's best suited for your outlook. So generally speaking, whenever we talk about options, whenever we talk about earnings season, there's really two choices. You can either buy an option like a call or a put, or you can sell an option like a credit spread or something like that going into an earnings announcement. And for those of you that have followed me long enough on Options Action on CNBC, you know around earnings season, the two primary strategies that I use are debit spreads and credit spreads. Debit spreads are when you're buying an option and you think the stock can make a big move, and credit spreads are when you're selling options and you think the stock is going to make more of a muted move. Now, like I said, one is not better than the other. It's just a matter of understanding the differences between the two so that you apply the right one for the scenario that you're trading. Does that make sense? Please type 2 into the chat window if that makes sense to you. So what I want to make sure is you understand what those pros and cons are based on these two strategies. So let's first talk about buying an option. So whenever you're buying an option like a call or a put or even a debit spread, this is what I call 1 step forward, 2 steps back. What I mean by that is that whenever you're buying an option like a call or a put going into an earnings announcement, you have two silent things in the background that are working against you. And these are things that are constantly working against you that you have no control over. And that's volatility crush and time decay. We're going to come back and discuss what those things mean, but these are two silent things that are working against you. And in order to make money from buying an option, you need to have the stock make such a large move in the direction that you expect it to. Not only do you have to get the direction right, the stock has to move large enough in order for the profit from the large stock move to overcome what you've lost to volatility crush and time decay. Sometimes you get the direction right, but because the stock didn't move large enough, you still don't make enough money to overcome what you've lost to volatility crush and time decay. Does that make sense conceptually? Please type 3 into the chat window if that makes sense to you. Even if you don't know what volatility crush or time decay means, right? This is just basic arithmetic that you have two things working against you, and you have one thing that could potentially, move the needle enough. Now, I will say, if you get the stock direction wrong, well, now you got 3 things working against you, and you're pretty much sure, have a sure bet of losing money. But what you're trying to do during earnings season is you're trying to call the right direction, and you're hoping that the stock makes a large enough move in order for you to be profitable to overcome volatility, crush, and time decay. Now, we're going to come back to go through these numbers and what these things mean, but I just want to first make sure everyone understands this on a conceptual level, okay? So when you're buying an option, 2 things are working against you that you have no control over, and the one thing you have control over is calling which stock is going to make a big move. And if you get it right, you can potentially overcome the volatility, crush, and time decay and turn a profit on the trade. Now, vice versa, if you're selling an option, whether you're selling a naked call or a put because you have a larger risk tolerance, or if you're selling like a credit spread, which is typically what I would do, because when you're trading options, you want to have limited risk, especially around options. Well, when you're selling an option, this is really where things get turned on a dime. Volatility crush and time decay are going to work in your favor. These are two silent things that you have no control over, but they're going to be profitable for you. However, because you have these two things working in your favor, what happens is you have one thing that could potentially put you one massive step back. So this is what I call 2 steps forward, one potentially massive step back. So whenever you sell an option, volatility crush and time decay are working in your favor. But if the stock makes a big move in the opposite direction that you think the stock is going to move, well, that move will likely become larger than what you're going to collect or what you're going to gain on the volatility crush and time decay. So you have these two silent things working in your favor, but then there's one thing where if the stock makes a big move in the opposite direction that you think it's going to go, well, that move is going to wipe out any gains that you get from volatility crush and time decay, and you're going to have a loss. If you do get the directional view right, then you have volatility crush working in your favor, time decay working in your favor, and the stock is moving in your favor. That is when you're profitable. But if you get the directional view wrong, likely that move is going to be greater than what you gain from volatility crush and time decay. Does that make sense from a conceptual perspective? Please type 4 into the chat window if that makes sense to you. Okay, so now that we've got theory and concept out of the way, let's put some real numbers around this. And this is really where we have to talk about Greeks. And I know when we get to the Greeks, this also throws off some people. Well, the Greeks, we're also going to talk about the Greeks on a conceptual level as well. And then the numbers, I'm going to show you how our platform actually does most of the work for you. So when we talk about Greeks, there are 3 Greeks that are relevant to trading options. There's delta, there's vega, and there's theta. What the Greeks tell you is the option that you're trading, how sensitive is that option to different variables or different factors. And delta tells you how sensitive the option is to the underlying stock price. So we talked about the stock price can move higher, it can move lower, it can move a lot higher, it can move a lot lower. So depending on how big the stock moves or how much the stock moves and in which direction, the delta will tell you how much your underlying option price will change by. Vega tells you how sensitive your option is to changes in volatility. So we talked about volatility crush. What volatility crush means is that the implied volatility of an option, let's say an option that you're buying has a 30% implied volatility. Now, 30% before earnings reflects the fact that the market and every participant in the market is uncertain as to what is going to happen around earnings. The company is about to report. Everyone's kind of on edge, trying to figure out where it's going to be. So there's a lot of uncertainty. And naturally, before an earnings announcement, that volatility number is going to be higher because there's that uncertainty around what's going to happen. And once the financial numbers come out, the uncertainty factor is gone. And what happens is naturally the implied volatility of the option will decrease because that uncertainty factor is now gone. We now know what the earnings are going to look like, or we know what the financial numbers are. So volatility comes down. So when we refer to volatility crush, we're referring to this decrease in implied volatility right after an earnings announcement. And what Vega tells us is that if the implied volatility of an option decreases from 30% to 25%, how does that impact the value of the option that you are holding? That's what Vega tells you. And lastly, Theta tells us, how does time affect the value of our option? So if we hold on to a trade for 7 days, let's say we buy an option 3 days before earnings, and we hold it 4 days post the earnings, and we hold that trade for a total of 7 days, how does the value of that option change with respect to time? So these 3 Greeks give us the picture of how much money we can potentially make or lose based on the changes in the underlying stock price, the changes in volatility, and and time effectively passing by. So for example, if you have an option with a delta of 0.5, a vega of 0.25, and a theta of 0.1, well, now I can do some math. And this is really where a lot of people say, this is where I lose a lot of people. And I always tell traders, you just have to understand this on a conceptual level. You never have to do the math. That's the benefit of trading in the day and age of the internet, because everything is done for you. The calculations are all done for you on the OptionsPlay platform. So you can just say, I think the stock is going to go up by $5. I think that implied volatility might come down by 5%, and I plan on holding on to this trade for 7 days. Well, guess what? OptionsPlay will do all of the math for you so that you just get spit out. Am I going to make a profit, or am I going to have a loss on that trade? We do all the math for you, and you can change scenarios. You can say, okay, if at $5 I make a $10 profit, how much do I make if the stock goes up $10, right? And you can do all these different scenario analysis, and that's the power of the platforms that we provide now, so that you can create these scenarios and say, at what point do I make money? At what point do I not make money? And make a decision as to whether this makes sense to you. So does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. And I'm going to come back and I'm going to give you a real example, right? I know at this point we've talked about theory, we've talked about concept, and especially if this is new to you, you're probably thinking to yourself, how do I apply this? Well, next I'm going to talk about the actual application with a real example. So the first thing what I want to do is walk you through the number one question that I get. How do I research stocks for earnings? And the answer is I start with our earnings calendar, because first of all, you need to know what symbols are reporting earnings that are coming up. That's the first step. And without this, I really don't know where to start my research. So the earnings calendar that's available to you on your OptionsPlay platform, when you go to the education and resources section on your OptionsPlay platform, that takes you to the hub. And when you go to the OptionsPlay hub, we have an earnings calendar. The earnings calendar will be able to show you what's coming up with respect to earnings. And more importantly, it tells you which one of those stocks, and some days there are hundreds of symbols that report on a given day. The question is, where do you focus your attention? And that's why I created the earnings calendar that's color-coded for you based on liquidity and based on the date that it's reporting. So as you can see across the top, these are the dates that are reporting. And as you go down, it tells you how many stocks are reporting on that day that are very liquid. I will tell you, whenever it comes to earnings season, I will not trade something that's not liquid. Especially with earnings season, I know I need to get in and out sometimes very quickly. I will not trade something that is considered not liquid. So it's color-coded for you. Green are stocks that are very liquid. Yellow are stocks that are somewhat liquid. And anything that's not colored are things that I will never touch, because these are stocks that are not liquid, and I'm not going to be able to likely get a fair price on some of these trades, or I might have to really work the order in order to get that fair price. The second thing I want you to know is that any stock with an asterisk next to it means that it's reporting on the morning of that day. If something doesn't have an asterisk, that means it reports after the close on that day. So if I'm looking at Bank of America on January 19th, I'll know Bank of America is liquid, and it reports in the mornings because it has the asterisk sign next to it. Alcoa, on the other hand, is liquid, but it reports after the close because it doesn't have that asterisk sign. Does that make sense? Please type 6 into the chat window if that makes sense to you. And this is going to make your earnings research a hell of a lot easier. I used to have to, I used to pull up an earnings calendar, and if any of you use like Yahoo Finance or NASDAQ's earnings calendar, you get a list of 300 symbols on some days. And I have to go through symbol by symbol to say, is that a symbol I recognize? Is that one that I think is liquid? And is that one that I want to research? It takes a lot of time. This brings down the list to just a handful that I know are very liquid and the ones that I'm going to research. So when CNBC, every single Friday, when we talk about what symbols are we going to cover, this is where I start my research. So I'm going to use Wells Fargo that's coming up. And I'm specifically using Wells Fargo because it reports tomorrow morning. And I don't want to do this making trade recommendations here. This is purely for educational purposes. You can't really trade this because the options markets are already closed. But I want to use Wells Fargo because I do think that it's a great example of a stock that has a lot of the elements that I'm looking for with respect to whether or not I think a stock is going to beat or miss on earnings. Because like I said, that's the number one question that I get from investors is how do I go about researching whether a stock is going to beat on earnings or miss? And again, just to reiterate, the answer is I never know whether a stock is going to beat or miss. But I do have a checklist of things that I go through. And the more things that check off, in my opinion, the more likely the stock is going to beat or miss on that on earnings. So I want to walk you through that checklist and walk you through how I research a stock based on whether I think the stock is going to beat or miss. So first and foremost, I like to look at the chart, and what I like to understand is whether the stock is outperforming its sector and the overall market. So here's a chart of Wells Fargo, and Wells Fargo has largely been range bound between, let's call it 52 or so, and it's been on this upward track, if you will. You can call it a triangle, you can call it a wedge, whatever you want to call it, but it's been largely range bound for quite some time. It hasn't really made much progress, and recently it broke out above this $52 level. Now, a breakout, in my opinion, by itself is not quite enough information. Breakout on high volume is good to know, but more importantly, breakouts that are relative to its market, also outperforming its market or sector, is really what I'm looking for going into an earnings announcement. Because what this is telling me is that it's not just Wells Fargo's is doing well because the rest of the sector is doing well, but it's actually doing better than the sector itself, right? Because if Wells Fargo is up 10% in the last couple of weeks, but let's say every other financial stock is also up 10%, on the week, then Wells Fargo is really not doing anything different than the market itself or anything different from its sector. So what I always like to do is a comparison chart of Wells Fargo to its sector, in this particular case, XLF. And what I see here is that as it broke out, this stock, the upper stock, also broke out at the same time. So what this is telling me is that when Wells Fargo, rallied roughly 12-13% in the past week and a half, the financial sector only rallied about 9 or 10%. So the fact that Wells Fargo is up 12-13% when the financial market is up 9 or 10% tells me there's something different about Wells Fargo. It's outperforming its sector. Those are the stocks that have a better likelihood of beating on earnings, and vice versa. If I was bearish on Wells Fargo, what I would like to see is that if it's breaking down, it's also underperforming its sector, because that tells me that this is a stock that is not keeping up with the other banks along with its peers. Does that make sense? Please type 7 into the chat window if that makes sense to you. Now, like I said, this in itself is not enough to say, okay, this is a stock that's going to beat or miss on earnings. But this is one of the first things that I look at. And I really don't like to trade many earnings announcements where I don't see this type of outperformance going into an earnings event, okay? So this is first and foremost. Relative strength to the market and to the sector is the first place that I typically look. The second thing I like to look at is, where's the consensus versus where analysts are currently expecting? And this is where I use a service called Estimize. And this is a service that you guys can all sign up. It's free of charge at estimize.com. The platform is free to use as a retail investor if you contribute to the platform. And what you can see is, what do contributors on the platform expect versus what Wall Street analysts are expecting? So at the moment for Wells Fargo, the users on the Estimize platform is expecting that Wells Fargo will come in at about $1.12 in terms of earnings per share, versus Wall Street analysts are currently expecting $1.04. And that 8 cents may not sound like a whole lot, but if you think about 8 cents per share per quarter multiply that by 4 quarters, that's about 32 cents in outperformance. Meaning if Wells Fargo makes an extra 32 cents per share for the year, and the stock is trading about 15 times earnings, 32 cents times 15 is quite a few dollars on the underlying stock itself. So 8 cents may not sound like a lot, but it could contribute to at least a $2, $3, $4 move in the underlying stock if you do see the actual numbers come out better than Wall Street is expecting. So this is another thing that I take a look at. And like I said, every single item that I'm showing you here by itself is not enough to say, okay, I'm fairly confident that the stock is going to beat or miss. But what I like to see is as many of these things line up as possible. And one of the things that this also shows you is not just what the expectations are, but there's also a tab here called trend. And what this also lets me see is how have things changed in the last week or two? We generally tend to see stocks that tend to outperform have changes in the last couple of weeks. So if it's $1.12 today, was it $1.10 last week, $1.08 the week before? Has the trend changed over the last couple of weeks? That's also an important factor. Or was it $1.20 last week and now it's down to $1.12? Have changes in the last couple of weeks is also very, very important to understand. And many times you see Wall Street analysts will change their expectations going into earnings. You see users on the platform change. And that trend is also quite useful in my opinion. Again, none of these things are the silver bullet, but the more of these things you see aligned with each other, the better. Does that make sense? Please type 8 into the chat window if that makes sense to you. Perfect. Another thing that I always look at, and this is a little harder to do, but it always is important to just understand, generally speaking, 2 important factors: top line and bottom line. Top and bottom line, how are they trending? Because if you think a stock is going to beat on earnings and you think a stock is going to do well and outperform the market, well, just as a general rule of thumb, you should see revenues that are growing and you should see earnings that are growing. And certainly earnings are more important than revenue, but I hate to invest in a business where earnings are growing and revenues are declining, because that tells me that there's something that's fishy about all of this, right? Because if a company is not making more and more money, how are they making more and more profits? So these are some of the things, and there's no right or wrong as to how you analyze it. It's just kind of a gut check, a sanity check on, hey, is this company growing? Is it growing their earnings, and is it growing their revenues? Now, it's tough, on a pandemic, after the pandemic, to see how things are going, because especially when you have 3 years of revenue decline and kind of 1 year where things kind of dropped off a cliff, but now you're starting to see things turn back again. Is this kind of a sign that things are going to get better for a firm like Wells Fargo? Hard to say, but certainly things are starting to improve here, right? So we had $72 billion in revenue last year. It looks like it's about going to be 75.5 this year. That certainly is a nice improvement over last year. So at least the revenue trends are starting to reverse back into the right direction. When we look at earnings, well, the one good thing about earnings is that we're now expecting to make more in 2021 than any other year in the past 4 years. So at least earnings is strong. And that's really part of what is driving Wells Fargo to its all-time highs, is that the earnings per share is at the highest we've seen it over the last 4 years. And that is a good sign for the stock itself. Does that make sense? Please type 9 into the chat window if that makes sense to you. Again, the financial statements is really more of a gut check, right? Just to see, hey, if I'm really bullish on a stock, are they growing revenues and earnings? If I'm really bearish on a stock, are those things trending lower? I usually like to see these things align. And the last thing I like to do is just looking at what analyst rating and research looks like. This is pulled from TD Ameritrade. For those of you that trade with, your brokerage firm either typically has access to the S&P, Morningstar, BAMO research, whoever your brokerage firm is, you're going to have access to different types of research reports. And especially if you're trading these liquid stocks, they're almost always covered by an analyst. And I don't necessarily look at what the analyst recommendations are as much. What I really look at is the analyst explaining what the company does. And this is something that I truly believe in, and I advocate. If you're going to trade anything, especially around earnings, you better understand what the company does. I can't tell you enough how many times I get notes or emails from investors telling me how they picked an earnings play because the chart looked great, and they knew nothing about what the company did. Well, I think that's a terrible way to invest, by not knowing what a company even does and how they make their money. So these analyst reports are really useful in giving you a deep dive as to what does the company do, how do they make their revenues, and how are they doing from a trend perspective, right? Are they a leader in this space? Are they what are the peers in this particular space? Because that's just going to give you another gut check of saying, does the current environment that we're in, does the company, by understanding the company and how they make their money, does the current environment make sense that this company is going to do well right now, right? So think about retail after the pandemic. It made a lot of sense that companies that were focused on e-commerce were going to do really well, especially when we weren't shopping in stores. Well, guess what? A lot of times you may not know how much money does a company make from e-commerce versus brick and mortar, right? You look at a stock like Macy's. For a long time, Macy's lagged behind because they make their lion's share of their revenue from brick and mortar, and they really had no e-commerce. Well, guess what? It's really difficult to know that unless you read the analyst reports and they gave you that kind of breakdown. So that's why I think these analyst reports are so important if you're going to invest, just to have that sanity gut check. Does that make sense? Please type 1 into the chat window if that makes sense to you. So that covers, the bulk of the research that I do on every single earnings play that I make. So when you see me make a pick on CNBC for earnings, these are the things that I look at, and I lay out the relative strength, the chart, the trends that the fundamentals are trending in, and what analyst expectations are, and whether or not it's trending in the right direction or not. These are the things that I look at to make a pick as to whether I think a stock is going to beat or miss on earnings. And Wells Fargo certainly kind of aligns with all of that. You have a strong relative strength chart outperforming its sector. You have consensus that's above Wall Street at the moment. Especially that trend has changed a little bit in the past couple of weeks in favor of Wells Fargo beating. You have revenue and earnings that are looking like they're trending in the right direction, and earnings look quite strong here for 2021. And especially if you read the analyst research, Wells Fargo makes the lion's share of their revenue from interest, net income from interest. And with a rising interest rate environment, that is supportive of a firm like Wells Fargo. And Wells Fargo and Bank of America sit separate from the rest of the market. And you really don't know that unless you read the analyst report and see just how much revenue Wells Fargo makes from interest and Bank of America makes from interest versus their other peers like JP Morgan and Morgan Stanley. And that's why Wells Fargo and Bank of America have outperformed. That's why I use Bank of America as my trade from a few weeks ago, because of this information. So these are the things that I think is really important to pay attention to. And Wells Fargo certainly sits at that. So what I want to do is I want to walk you through some ideas as far as, okay, if you have a bullish view here on Wells Fargo, how can I utilize options to play this? And I'm going to show you 3 strategies. I'm going to show you three bullish strategies, but I'm going to show you 3 strategies where I'm going to either sell an option versus buying an option. So you'll typically see me on CNBC either sell a credit spread or buy a debit spread going into earnings. And what I like to do is really compare the two side by side, get a better understanding using the P&L simulator, because before we talked about 3 factors, right? We talked about volatility crush, we talked about time decay, and we talked about the stock making a move in the underlying stock. So, and I talked about how our platform does the work for you. So you have the price the stock goes to, you have the date, and you have the implied volatility. And what you can do is play with this and say, well, what happens if the stock goes higher by a certain date? And I know volatility is going to come down. well, which strategy is going to give me the returns that I'm looking for? And the other thing that I'll also keep in mind is how far has the stock already moved, right? The stock has already moved from 48 to 56. That's a big move in a week and a half. So maybe the upside here is fairly limited. So I have to factor these things into my view. So let's say I think the stock's going to move up to 58 by let's say the end of January, and I know the current implied volatility of Wells Fargo is around 31.5. So let me move this down a little, maybe to 25%, and see which one of these strategies will outperform, right? And not only do I want to look at how much can I potentially make, I also want to look at how much can I potentially lose if the trade doesn't go in the direction to, because as much as my research tells me that I think Wells Fargo is going to beat, it very well could miss. And if it misses, the stock is likely going to take a big tumble, and I want to know how much do I have to risk. I'm risking $136 versus $200+ on these two other strategies. So I'm going to factor these things in to decide whether I think I'm going to sell a credit spread versus buying a call or buying a call spread. And these are the things that I look at to determine, okay, do I think I want to be selling going into earnings, or do I want to look at buying into earnings? The other thing I will also take a look at here is IV rank. In this particular case, the Wells Fargo's IV rank is relatively on the high end, 38%. So this certainly would also lean me towards potentially selling, especially if I think the upside is limited because of the fact of a few things that we talked about. Stocks that beat are not seeing big moves to the upside, and Wells Fargo has had a pretty big run already, so I don't know how much upside we have here. So I would probably lean more towards selling a credit spread versus buying a debit spread, because a debit spread would require the stock to make a big move before I start to see some significant gains on the underlying strategy. But the P&L simulator becomes a really powerful tool in your arsenal in order to test out your theories, try out different strategies side by side, and make sure you understand what can you potentially lose, what can you potentially make. But the most important thing is that all of these three strategies that I'm referring to here on the right-hand side have limited risk. Whenever you're trading earnings, make sure you use strategies that have limited risk, because you never know what could happen. The stock could have a really bad quarter and the stock tanks. You want to know that you know how much you can potentially lose. In all three strategies, I have a max risk. I know no matter what happens, I cannot lose more than that amount. And that protects you to the downside if you get the earnings calls wrong. And I've made some spectacularly wrong calls. For those of you that have followed me on CNBC for the last 8 earnings seasons that I've been on this show, I've gotten some things wrong. And when you get it wrong, these limited risk strategies protect you. And that is more useful than anything else when it comes to utilizing options for an earnings play. So with that covers what I wanted to share with you here today. I really hope that this was helpful in giving you a better understanding as to what option strategies are useful around earnings, the difference between them, because buying versus selling, one is not better than the other. They're just opposite ends of the coin. It's important to understand which one's better than what are the pros and cons of each one, so you know which one to apply. And then hopefully this gives you an idea as far as how can you go about researching the upcoming symbols that are going to report earnings, which ones will beat earnings, which will likely miss on earnings. Those are the things that I look for when I do my research. So with that, I want to thank everyone for being here today, especially the members for supporting us and allowing us to continue to do this educational session. I am really excited because we are kicking off 2022 with a lot of new things coming up. I have a big announcement to make here at the end of January that's going to provide a lot more in terms of research that we're going to be providing to you guys on a daily and weekly level from someone in the industry that I greatly respect that is going to be coming on board with us here at the end of January, helping with providing better ideas out to you guys as well. More educational sessions. We're going to hire another educator here in February as well. So a lot of great things coming in 2022 that I really want to share with you. We have a mobile platform coming up. We have a whole new design to the platform. Neutral strategies are coming. And this is all available to you. If you're a member, you're going to get access to everything immediately. If you're not a member, if you're just learning about OptionsPlay, you can sign up for a free 30-day trial at optionsplay.com. This will allow you to get a free 30-day trial to everything that we have to offer, our daily trading signals, and our weekly events that we run on different ideas and education, like the sessions that we are on here right now. So with that, I want to open this up for Q&A. If anyone has any questions, there's a chat window and there's a Q&A section. If you could please type your questions in the Q&A section, I'll try to answer as many questions as I have time for here in the Q&A section. Daniel's asking, does the time decay occur overnight or throughout the day? It occurs 24 hours a day. Even though you can't trade the option 24 hours a day, the decay happens over those 24 hours. Can you Schwab do earnings next week, or Bank of America? Jake, I'll be honest, I'm going to be doing my research tonight for what I'm going to be talking on CNBC later tomorrow. So I don't actually know which symbol I'll be looking at on CNBC. I will know by tomorrow morning, and you guys will see it on CNBC tomorrow afternoon. How do you do a stock chart relative to its sector on stockcharts.com? So stockcharts.com, you can do it based on the symbol. There's a price indicator, and you can do symbol, semicolon, $ sector. Bob Delaney, once earnings are released, many stocks, even those that outperform their sector, often slump. Can you comment? Yes, Bob, that's exactly what the statistic I was showing you here in the very beginning. In Q3, stocks that beat only moved on average of 0.31%. Stock that missed moved to 1.6% lower. So last quarter, we saw much bigger reactions to the downside than stocks that moved to the upside. That's why I think you're going to see more opportunities on bearish stocks than you're going to see on bullish stocks this particular earnings season. What is the most appropriate time to enter into an earnings play? Generally speaking, the week of earnings, meaning a day or two before the earnings announcement itself, is your optimal time to enter a trade before earnings. Where do you typically get your revenue or earnings info? Michelle, this is probably the easiest because you can get that information everywhere. Whether you go to Google Finance or you go to Bloomberg.com or your brokerage firm, these are all publicly available information. You can even go to the SEC website, but pretty much any financial website will have these numbers. TradingView has its, pretty much any financial website providing financial information has revenue and earnings numbers and financial statements for publicly traded companies. Wells Fargo has had some credibility issues in the past. Well, Ken, you're absolutely right, but that really has nothing to do with earnings, and that certainly has nothing to do with whether a company, how the markets react to the earnings themselves. How do you use the implied volatility tool more effectively? The thing about implied volatility change is that it's an art, not a science. I usually just move this slider about halfway down from where it currently is to the bottom of the range. And that's usually a pretty good estimate as to where implied volatility will land after earnings. Even though the implied volatility rank is 38%, how do we know if this thing is high or not relative to what? So 38% is relative to itself. It's 38 percentile. So 38 is basically telling you what is the range from the last year and where it is within that range. So if it's 38, that means this is where it is within the overall range relative to itself. So that's what IV rank tells you, is where it is relative to its own range. And that's why IV rank is much more useful than implied volatility, because the implied volatility is 31%, But what was the high of the year and what was the low of the year? You don't have that information. Implied volatility rank tells you where the current implied volatility is relative to its own range. Where do you get the relative strength chart? So Dwayne, you can do it on pretty much most charting packages. You can do it on TradingView. You can do it on stockcharts.com. I use both as far as those relative strength charts. Can you comment on the timing of the OptionsPlay reports? The cover call reports are only updated 3 times a day. During the day, it's updated twice, and it's updated once after the close. The cover call reports are not updated every hour, if that's what you're asking. Do you ever use calendar spreads to trade earnings? Yes, I would say that probably 80% of my trades are credit versus debit spreads during earnings, and then the other 20% of the time they are using calendars and diagonals. Can an iron condor or a strangle be assigned? Well, technically any strategy with a short strike can be assigned. So both strangles and iron condors have a short strike. So those short strikes are the closest strikes to your strategy. So yes, both can be assigned. Often the reaction to the stock is unpredictable, goes down when it beats, never know for certain. That's another, you're absolutely right, Julie. You don't know what the reaction is going to be. So sometimes you can actually get the directional view right. You can get the fact that the stock beats or misses correct, and the stock reacts in the opposite direction. Many times that's because perhaps the market is expecting a beat, but the beat comes in smaller than expected, so the stock sells off. Or there's some underlying information, like for example, if Netflix, hits their target on earnings, but misses on something like subscriber growth, it depends on each stock, right? And you kind of have to know about these stocks to understand this. And this is really why I think it's important to dig into those analyst reports, because those analyst reports gives you insight into what the market really cares about. So if you look at a stock like Netflix, right, it's probably the market cares more about how many subscribers they've added rather than how much they earned on the stock itself in terms of profits. So, and these are things that you only find out as you dig into those analyst reports. So the more you dig into those analyst reports, the more likely you have some sense as to what the market really cares about, depending on the stock that you're trading. Can you explain the OptionsPlay score? Sure. The OptionsPlay score is really looking at 3 things. It's looking at the max risk, the max reward, and the probability of profit. Because those are the 3 factors that really determine what is your probability of success and what is your risk-weighted risk to reward ratio. And depending on the strategy, some strategy have a max reward that's unlimited. So how do you even calculate risk reward on something that's unlimited? It's impossible. And that's why we created the OptionsPlay score. We wanted you to have one single way to calculate risk to reward weighted by the probabilities in a single score. So the OptionsPlay score gives you that overview as to what is your expected return on these types of strategies. Green means good expected return. Yellow means average. Red means poor expected return. Could you talk about some neutral identifying things to look for and some strategy that would go along with that? I'm not sure what you mean by neutral identifying things. If you're talking about neutral strategies, credit spreads is certainly the strategy that I would typically use in a neutral market. I actually just did a webinar a couple of weeks ago on how to trade sideways in choppy markets. If you want to look that up on YouTube, on our YouTube channel. So we talked about, I think you're saying like what kind of technical indicators can identify neutral markets. And I did talk about that as well during that session, Carson. So please look that up on our YouTube channel. It is at youtube.com/optionsplay. And I will post that into the chat window for those of you that are interested in checking us out on YouTube. You mentioned that one sector did not perform in Q3. Which sector was that? I'm trying to remember. I have the research, but I actually forget which sector did not beat consensus in Q3. I have to look that up, unfortunately. What is the IV spread? Implied volatility spread. I'm not 100% sure. I need a little context in terms of what you mean implied volatility spread. I think generally speaking, we talk about things like calendars and diagonals as time spreads, but there are also volatility spreads as well. But technically any spread is an IV spread, right? Even debit and credit spreads are technically IV spreads. You're trading one, you're buying one and you're selling the other. And obviously whenever you buy IVs that are low and sell IVs that are high, that's going to put an edge in your favor. How do you close out of a sell and buy to avoid naked position? I'm not sure what you mean by that, Donald. If you have two legs, you always want to close out both legs together. And if you're not sure how to do that, Donald, that is a question for your brokerage firm. Call up your brokerage firm, say, I have a spread position where I have two legs. How do I close out both legs at once so that I don't have a naked position? Your broker will be able to help you with that. I have spoken to seasoned options traders who say they never trade around earnings. Mark, there's nothing wrong with avoiding earnings. Each to each their own, right? I would say that the options traders that avoid earnings are usually a bit more on the conservative side. Maybe their focus is more on income rather than speculation. But I certainly think that anyone who's a bit more risk focused and is a speculator will almost always use options to trade earnings. But certainly nothing wrong with avoiding earnings whatsoever. Can you distinguish selling call spreads versus selling put spreads coming into earnings? It's just a matter of direction then. Selling put spreads, you do that when you're bullish on the stock. Selling call spreads when you're bearish on the stock. There's nothing else. It's not a matter of choice or preference. It's a matter of whether you're bullish or bearish on the underlying stock. Do you recommend a 45-day expiration on your spreads even if earnings are next week? If earnings are next week, I typically bring them in a little bit to about closer to 30 days. But otherwise, I would use a 45-day expiration. You referenced the uncertainty going to earnings being a factor that keeps many from trading around earnings. I'm not saying that the uncertainty is what keeps people from trading around earnings. I'm saying the uncertainty is what elevates the implied volatility of an option going into earnings. How much after the free 30-day trial? Kevin, you can see that on our website. If you go to OptionsPlay.com, if you go to the product page, it will show you the pricing. I just opened an account with National Bank. Do I also have access to free education sessions? Alvin, no, unfortunately, that is separate. So, what National Bank gives you is only what you get on the National Bank platform. It does not include our education package. Will you have any potential artificial intelligence programs coming into OptionsPlay? So, Andrew, great question. A lot of the things that we have built into their OptionsPlay hub was built on a lot of machine learning and optimization that we have done in the past. So, even though it's not directly built into what you're seeing, the work of our machine learning and artificial intelligence work is is embedded into the platform itself. Okay, so with that covers the questions that I have time for here today. There are so many questions here. Thank you so much for everyone participating here today. I'm sorry I couldn't get to all of your questions, but I am hosting an AMA, and Ask Me Anything, at the end of this month. So I hope for those of you that are members, because if you're a member, you're going to be able to submit questions. This is a session on Friday morning at 8:30 a.m. You're going to be able to submit any question. You can ask me anything, personal questions, trading related questions. Nothing is off limits. So please, I'm really looking forward to that session. I hope many of you will be able to join me for that session. I'm really looking forward to it, and I know many of you guys are as well. So with that, thank you so much. Have a great trading day. We will send out both the recording and the slides out to you for those of you that are members immediately after this session. Thank you so much for those of you that have congratulated me on being a father. It has been a fantastic experience so far. So thank you so much to everyone, and have a great trading day.